Thanks a lot, Alex, and welcome everyone. A lot of familiar faces in the room today, which is fantastic. A lot of people that have been supporting our business since we kicked off 6 years ago and been along for the whole journey. So thanks for coming along, and welcome to the new faces as well. Hopefully we can explain a few of our thoughts today and give you some insights into the processes that we follow and the way we go about putting our portfolios together. We have an AFSL, as you probably know. We have a license to give general advice only, so anything that I say today is not taken into account your personal circumstances, and you should think about that and seek advice where appropriate. And any reference to performance figures is obviously about the past and no guarantee of anything that will happen in future. I'm going to talk about a few different things today. Firstly, I guess a few issues that I am concerned about. Firstly, in commodities markets and commodities stocks. Secondly, with the Australian economy, and those two things are related, the flow-on impact of what we're seeing in commodities markets for the Australian economy. And then I'm going to talk about where we are finding value out there, because I think the macro theme, particularly for Australia, is quite pessimistic at the moment. And I actually agree with most of the pessimism. It's also factored into stock prices in a way which is quite attractive. There are opportunities out there to make money, and we're going to talk about a few of those today. And then finally, we're going to give a bit of an update about the business. I know it's something a lot of people are interested in. Talk about the performance of the funds and where we're at, and a little bit about what we want to do over the next few decades. This is a chart showing the last 18 months of the oil price and the iron ore price. It's probably a familiar one to anyone who owns stocks in either of those spaces, and it's not just oil and iron ore. You could look at copper, you could look at manganese, you can look at basically every commodity around the world, and you would see a similar decline in prices like that. Both oil and iron ore are down 60%. I want to talk a little bit today about the differences between the different commodities though, and why we do have a little bit of exposure to oil and almost no exposure to iron ore. I think they're two very different commodities, and I think across the commodity space you're going to see a lot of different performance over the next 5 to 10 years. The reason relates to the asset lives in these different commodities. So what we are seeing at the moment, pretty much across the board, is a level of supply that is higher than the level of demand that is out there, mostly as a result of Chinese growth slowing down to levels that are lower than people thought when they built all of these mines. Now, in the short term, the price will trade at a level that tries to clear the market. So all that really matters is the short-term cost of production. And I think in oil and in iron ore and in copper and all over the place, you're seeing mines that are not earning great returns on capital keep producing because their short-term cost of production is still lower than the current price. So you've invested all of this capital in a mine, but that money is gone, it's sunk. You sit there today and you make a rational decision about, it costs me X to dig it out of the ground and I can sell it for Y. And whatever they can keep doing that, they're going to keep producing, and the price is going to keep falling until some of that production comes out of the market. Now, what's important here is that over the medium to longer term, that cost of capital does become important. So if you're sitting there thinking about building a new mine, you're going to take into account not only what your cash cost is going to be, but what it's going to cost you to build it. Now, in the different commodity spaces, that dynamic is going to play out very, very differently. And the reason is because there's more capital that needs to be spent in some, and there's none that needs to be spent in others. This is a chart of the production curve for its non-OPEC and non-US oil around the world. And you can see that we're currently producing a bit over 41 million barrels of oil a day. Those markets are producing that out of a total of 91. The dark blue line that you see there is the reduction in existing fields over the next 10 years, basically. And you can see that it is going to drop off very, very significantly. The shaded blue there is current projects that have been committed to, where the capital is being spent, where the production is going to come online. And then the light blue out there is projects that need to be built in order to meet demand over that period. And this is very important for oil. The annual production declines at roughly 6 to 7% per year. So this oversupply that we have is going to clear relatively quickly, while ever we're not spending capital on building new production. And that decline in capex is happening at a very, very rapid rate. We own some oil services businesses in our international fund, and we're feeling that very directly. But capex in the oil space is down 25% in 2015. It is expected to fall another 10% in 2016. So you're going to be 35% lower than you were in 2014 in terms of the capex that's being spent. That is going to flow through to production very quickly, and you are going to see that price return to a level that encourages new investment. It's pretty clear across the industry that the price needed to encourage new investment has come down, and it's come down a long way. The costs in the industry have fallen. But the current capex numbers are telling you that it's higher than $50. It's almost certainly higher than $60. I don't know whether it's $75 oil price, $85 oil price, potentially $100 oil price longer term, but it is certainly higher today. And that dynamic is going to feel like forever if you're invested in the space over the next 12 to 18 months, but it's going to play out relatively quickly. Now, this is a comment from Wood Mackenzie on the iron ore market. They said there is no requirement to incentivise supply until 2030. So the dynamics of the iron ore market are very different. You build all this capacity, you build a railway line to port, which is that infrastructure is a huge part of the cost. You can keep digging for years and years and years without developing new mines. And this is saying that that's another 15 years before anyone even needs to think about it. So I think the medium-term incentive there to add new capacity is not going to drive the price. And I think that the demand situation is also potentially a lot weaker in iron ore. Most of you will know we've been pretty bearish on China for a long time now, and I think that has become more of a consensus view. I still think in terms of demand for commodities, most people are running around and saying, well, the demand growth is not going to be what we thought it was going to be before. Even for Chinese demand for iron ore to stay the same as it was last year, they need to build the same amount of roads, the same amount of airports, the same amount of infrastructure into a market that is already dramatically oversupplied. Now, I don't know what the number is, but I wouldn't be surprised at all if demand starts falling and potentially falls quite significantly in that iron ore market. And China is 40 to 70% of production. It's half in iron ore, and across different commodities, you're looking at 40 to 70% of demand for those commodities. So in oil, China's about 15% of world demand, and these other commodities, they represent a lot more. So I think that demand dynamic is also going to play into things here. And in iron ore, at the moment, you've got a price that is pushing a lot of high-cost producers out of the market. You know, the likes of Atlas and BC Iron have to stop producing, but they're relatively small bit players in the market. I think if you start seeing BHP, Rio, Vale compete with each other for market share, then you could see a lot lower iron ore price than you see today. So we've seen this massive sell-off across the space. We're reasonably optimistic about oil, although still very wary of the whole volatility in the space. We're quite pessimistic about iron ore, and pretty much everything else is somewhere in between. You know, the numbers on copper look reasonably good from 2019, 2020. Most other commodities are somewhere in between that. Iron ore, there's enough production here to last for a very long time, and oil where it's going to drop off quite quickly. It's an interesting space. There's a lot of pessimism. There's a lot of people selling these stocks without any regard to price. We are working hard. We are treading very, very carefully is probably the best way of putting it. This chart is BHP's return on assets in its iron ore division, and you can see there that they were making 70% returns through the boom times. It's fallen a long way as the iron ore price has fallen. It can still fall a lot further, and BHP will be still profitable in that division. So this chart actually refers to that point that I just made about if they start competing with each other, the price can fall a long way from here. When we first started talking about China back in, what would that have been? I mean, it was when we first started the fund, so 2009, 2010. We talked about three things. Well, we didn't want to own commodity stocks. We didn't want to be invested in the Australian dollar, and it was a big driving factor between our portfolio construction and also launching the international fund. The third penny that we talked a lot about was the wider implications on the Australian economy. Do you want to own banks? Do you want to own stuff exposed to residential property? As this commodity crash hits, what is the impact going to be on Australia? Now, I would say that I mean, there's weak economic growth out there, but I would say that has not been anywhere near as bad as I would have expected 6 years ago, given the magnitude of the sell-off in commodities. And I sit there and I say, well, that is good, and hopefully I am wrong about that third penny to drop, but I also want to understand why it is and what's happening that's offsetting that decline in commodities. This was a chart that was up on Bloomberg last week. You've got countries around the world ranked by the percentage of their exports that are going to China. And little old Australia is at the top of that list with 35% of our exports going into the Chinese market. Now, the blue line is probably more important than the red line. This chart looks really scary, but because exports are a relatively small percentage of Australia's GDP, the percentage of GDP is 6 or 7% rather than the 35% in exports. If you look at a country like Singapore, it's a small percentage of their exports, but a bigger percentage of their GDP. So that is more important. But this is a really big issue for Australia, and it's a very big part of our economy. So how are we holding up as well as we are? Now, the lower Australian dollar is a big positive impact. And when you compare what's happening here with what's happening in Greece, it's a very pain-free way of adjusting our competitiveness. So in Greece, cost of labour is too high, it's an uncompetitive country, they need to fix that. The way you get wages down is massive amounts of unemployment and people need to drop their wages. Here in Australia, we've had a currency decline that most people haven't really noticed in their day-to-day lives. That means we're all 30 or 40% poorer relative to the US. We're a lot more competitive, but we're not feeling the same degree of pain. So that flexible exchange rate is a huge advantage. We've also seen, though, and you've probably noticed this, that the construction part of the Australian economy is going particularly well at the moment. We had Watpac in our office 3 or 4 weeks ago. They said the first quarter of this year has been the best quarter they've ever seen in terms of new orders into their business for construction. That's happening across commercial property, it's happening across residential property, and it's now starting to flow through to infrastructure as well. Something that worries me, though, is that this is being driven by debt. And this is a chart familiar to people who've been with us for a long time because it's something that we've been worried about for a long time, and it's the debt to disposable income in the Australian economy. That yellow bar there goes back to 1988, and it shows the percentage of our disposable income that we've taken on in debt. Now, financial crisis hit 2007-8, and we saw that number level off quite a bit at 160, 163%. Just in this last year or two, it's ticked right back up to north of 180%. So I think what you're seeing is that a lot of this stabilisation of the Australian economy, a lot of the reason that it's not performing as badly as I would have expected is that we're all borrowing more money and we're using that to fund largely residential property construction. The grey line there is the percentage of our disposable income that we're spending servicing that debt, so basically the interest cost on the debt. Those of you who had a mortgage in 1990 will realise why that number was so high, because interest rates were so high. But basically in 1990, we were spending more than we are today servicing our debt, despite that debt level being 1/3 of what it is today. So you can see that the debt levels have run right up, but the cost of servicing that debt is roughly the same as it was almost 30 years ago. And the reason is that we have very, very low interest rates. Now, I don't know whether this goes into reverse in a dramatic way, but it is certainly a tailwind that can't keep going on forever. Interest rates cannot get a lot lower than where they are today. Therefore, our ability to keep taking on more debt is starting to hit upper constraints. This is a chart that shows Australia's debt to GDP ratio versus some other important countries around the world. We'll start with the Germans down the bottom there. Basically, since 2000, they've been paying off debt and saving more than they earn, and that debt to disposable income ratio has come right down. The UK, you can see the financial crisis, it's a very clear point on that chart, up to about 175%. It's come back down quite significantly then. The same in the US, up to 140%, right back down to 108 now. And one of the things that's really starting to play out in the Australian economy is that this trend is coming to an end. So that has been a huge detractor to economic growth in the US since the financial crisis, that there's been this debt repayment going on. It looks to me like that's starting to level off, and you're starting to see people borrow more money, and that's having a positive impact on the US economy. But the Australian numbers just kept going up and up and up, and it's similar to our commodity-related friends in Canada, where their debt-to-disposable income number has kept going up and up and up as well. So they've had that adjustment in some of these big overseas economies, and you've seen it flow through to much lower economic growth numbers in recent times. I think you're either going to see something bad if there is a serious retraction in these numbers here, and that number has to come down through debt write-offs and bad debts, or you're just going to see a long period of subpar economic growth as we slowly muddle our way through these debt issues. It's a really important issue for the Australian economy. I think it's one factor that the RBA is not talking about, but that is important when they're sitting there thinking, well, do we really want to cut rates further and just keep pushing this number up? It's only storing up problems for down the track. So despite my questioning whether we were right about that third penny to drop, we're still treading very, very carefully in terms of our exposure to anything really that's related to employment, related to GDP, related to banks, domestic economy focused stocks. We're still treading very, very carefully in that space. Not saying we don't own any, we own Wattpac as I said earlier, but we own things that we think are very, very cheap and where we think we can make money even in a very bad economy. So what are we doing? I think there's lots of things in the world to be worried about, and I get a lot of people ringing me up saying the Aussie dollar is going to go to 50 cents and very sure in their views about these things. I do think a lot of this is priced into asset prices at the moment. We were at a value investing conference in Italy in July, and I put up a few stocks that I thought were quite interestingly priced in Australia, and there was just unanimous feedback from the crowd that they are not the slightest, these are international investors, not the slightest bit interested in investing in Australia. They just don't want to borrow of it because they're rightfully worried about the prices of the banks. They're worried about our exposure to China, but there's this blanket view that I won't invest in anything. And on the ASX, we have plenty of businesses that are not dependent on the Australian economy and that are trading at quite attractive prices. So I don't think this means don't buy any ASX listed stocks. I think it means use it as your backdrop and put together a sensible portfolio with that in mind. I actually think in general, Gareth wrote a really good blog post last week talking about the Baupost quarterly letter recently, and there's a guy who's leaving Baupost who wrote a piece for them about their investment process, and he talked about this tide goes in versus tide goes out investing, where they wait for everyone to panic and then they go out there and they buy a lot of stocks en masse, and that happens relatively rarely, every few years in various guises in different parts of the market. Most of the time what they're doing is going around looking for needles in the haystack. They're looking for individual opportunities that are mispriced for a specific reason, but in a normally functioning market where there's reasonably well-informed sellers selling to reasonably well-informed buyers. They may have different views on a stock, but no one is distressed and no one is forced to sell into that market. And I would say that we're quite clearly in a needle in the haystack type market. I don't think it's a time to be rushing into anything in particular. People ring me up and say, well, should I be all in the international fund or all in the domestic fund? And I just think it's a time to have whatever your set portfolio allocation is, you shouldn't be too far from it at the moment. If you think your portfolio should be 40 Aussie equities, 40 international equities and some cash, then now's probably a time to be reasonably close to whatever you think is normal rather than doing anything drastic. We are finding a number of needles in the haystack that we think are very interesting, and we're trying to manage our portfolio in a way that we can take advantage when the tide goes out and we can deploy a lot more capital, but we can make money through these sorts of markets as well, and we've been having a pretty good time of that. These are a few stocks that are in the international fund. I wanted to talk about a couple today that we haven't talked about in our quarterly reports. We've got smaller stocks in the portfolio now that we don't really want to tell the world about until we've got our fill of them. But there's a couple that I wanted to talk about today that we haven't mentioned before. The top one there's Lotto 24, and it's quite an interesting story. We own a company called Jumbo in our Australian portfolio, and they sell online lottery tickets here in Australia. So you can go onto their website and you can buy a TATS lottery ticket through their website. And they've built quite a successful business in that space. They're up to about 1.8 million Australian customers now, and people play pretty regularly through the phone and through their website. They've been the last 5 years now obsessed with grand international expansion plans. So first they were going to go to America, then they were going to go to Mexico, and then Germany was high on their list of places where they were going to expand their business. They're going to take this technology and knowledge they had in Australia and use it in other markets that hadn't yet gone online. The German market had basically been closed to online lottery tickets since 2009. There was a nascent, grey market for online lottery tickets. There were people building businesses in an unregulated environment up until 2009. In 2009, the government shut it down, and in 2012, they came out and said, okay, we're going to allow online lottery ticket sales, but here are the rules and regulations. And Jumbo said, well, there's a market that's well regulated, it's a market that we know, we're going to go over there and do what we've done in Australia. But they said to me in a meeting, we're going to try and be number 2 or 3 in the market. And I said, well, why number 2 or 3? What's wrong with number 1? And he said to me, well, there's this company over there that built a very big business in the period up until 2009, and they're coming back just like we're coming back, and they know exactly what they're doing, and they've done it all before. And we don't really want to take them on. We don't think we can take them on. We think we can have a nice little business being number 2 or 3. Turns out that number 1 business was called Lotto24, and it's listed in Germany, and it was trading at a very attractive price given what we knew about the business model. It's run up quite a bit lately, but it's one of our larger holdings in the international fund, and I think a good example of a stock that we don't really care what happens to the global economy or the exchange rates or any of that sort of stuff. We've got a nice little business here that is growing very, very healthily and is going to perform well irrespective of what happens to the wider economy. Karp's Traffic.com, if you've been reading your quarterly reports, you probably know a fair bit about this. They are an Austrian company that provides toll road technology, and most of the toll road technology in Australia is theirs. So they sell to the likes of Transurban the gantries that go on the road, the detection stuff, and actually the tags that go in your car. About 70% of the Australian market is made by Karp's. They have a huge European truck tolling business where they actually own the right to collect the tolls as well and pay those tolls across to the government, and that's the main part of their business. We really like this company. It's got a division that's losing money that we don't think will lose money forever. It has a very profitable, reliable tolling business, and it has a few almost Google-style moonshots, parts of its business that may be worth something that we're not attributing any value to. Again, the stock price has run up quite a lot over the past 6 months. It's not as cheap as it was, but it's another good example of the type of needle that we're finding in a haystack. And finally, I just put a little one up there. We would like to own more of this stock. It's called Serene Technologies, and it's listed in Singapore. It's an Israeli business that manufactures diamond manufacturing machines. You get a rough diamond. It used to be a person who sat there and worked out what the best way to cut that diamond up was and then go ahead and do it. And you would typically get 3 to 4 polished diamonds out of one rough diamond. These guys developed some technology that lets you basically, if you think of it like an X-ray machine, you put the rough diamond through an X-ray machine, you send that data off to Serene, and they send you back a map that says if you cut this diamond up in this particular way, you're going to get the most economic output out the other end. That technology has basically taken over the rough diamond market. If you are out there processing rough diamonds, you need to use that technology. You get 6, 7, sometimes 10 polished diamonds out of the same diamond that you used to get 3 or 4. And they have sold every single machine that's ever been sold in this space, and they collect a ticket every time someone processes a diamond. So you have to put the diamond through, you send the data off to Serene, they send the analysis back to you and charge you $20 for it, for every diamond. If anyone's thinking of getting engaged at the moment, it's a good time to do it because the diamond market is in a state of flux and prices are down a very long way. Again, because of what's going on in China, largely, and oversupply issues coming from De Beers. So you're seeing effectively a standoff between these Indian processors of diamonds and the big producers like De Beers about what the appropriate price is, and volumes are down very significantly. So the share price of this company has halved in the last year. We think it's a good long-term business. It won't make any profit at all this year because the processing levels are down so low. We think it's got quite an attractive long-term future. Again, we want that price to be lower than it is today, and we think it's currently trading 140 or so. If we can see it in the 120s or lower than that, it will be a bigger position in the portfolio. I'd like to see more of this sort of stuff in the international fund. We launched the fund in a hurry in 2013 because we were worried about the dollar and we wanted to get money invested offshore. We started with a lot of big blue chips like AIG and Google and Amex. I think our edge is going to come in stocks like this over time, and I would like to see an increasing percentage of the portfolio invested in these types of businesses. We are a small team. We are going to have an edge in these types of businesses rather than some sort of analytical edge analysing an American Express or an AIG. I think they're great businesses. I think they'll give us adequate returns over time. But for us to add the excess returns, it's really this type of thing that's going to do it. Some of these names are going to be familiar with you. We've owned RNY now for more than 5 years. It's still the largest holding in the Australian fund, but only just because its share price has come down when some other things have gone up a lot. Those three stocks are our three largest holdings, and you'll see that they've got nothing to do with each other, and that's something that I'm quite excited about in the Australian fund at the moment, is that we've been able to put a portfolio together that's not highly correlated with each other. So we've got a stock at the top there that's a portfolio of US office properties. It's listed in Australia. It's trading at less than half NTA. It has its problems. These assets are suburban office blocks, and the market in the US has shifted from people wanting to drive their car and work in the suburbs to people wanting to catch public transport and work downtown. And in some ways, I mean, I shouldn't call them stranded. They're still 80% occupied, but the properties are not in a space that's particularly appealing to investors at the moment. So we've had some very good news on that front. I mean, that share price is up almost threefold from where we bought it 5 years ago. But it also hasn't come to fruition in terms of us exiting the investment as quickly as we would have liked. We should see some news there over the next 6 to 12 months that's going to either crystallise the value that is in this trust or recapitalise it to a point where it can get back to paying distributions and do the things it was meant to. But it's a nice stock to hold in this Australian portfolio where we're worried about the Australian economy. Service Stream, we've written a lot about it, so I won't talk too much about it. There's two examples of stocks here that have doubled in the last year or so where I think the value is still very attractive. Now, in the case of Service Stream, that is more about, I just don't think the market has yet realised what's going on with that stock. Obviously, the price is up, so it's realised that to some extent it's still not covered by brokers, it's still not owned by any other institutional fund managers. And I think as they start to look at this, and it's pretty obvious that it's trading at a single-digit PE, that it's going to throw off a lot of cash and that it can pay a high yield, you'll see that start to be reflected more in the price. So it's not the cheapest stock in the portfolio, but I'm the most confident that it's going to see its value reflected in the price in the relatively short term. And then McMahon Holdings, again, this stock price has doubled in the last 4 months. I actually think here the opportunity is more attractive today than it was 4 months ago. 4 months ago, we had a business that had a lot of, well, not a lot, but it had debt. It had some assets stranded in Mongolia. It was losing contracts left, right, and centre. It had a market cap of $50 million, but its survival was in question. Today, it's got a market cap of $110 million. It sold those assets in Mongolia for $70 million. It's now got $70 million of net cash. It's won 3 new contracts in the past 3 months. It looks likely to me that it's going to throw off 40 million, is that a fair number, Matt, of cash flow in the next 12 months? And to be able to do that on a fairly consistent basis for the next few years. It's got relatively long-term contracts now. They're all in the gold space, so we're now going to be watching the gold price carefully. But it's a safer, more interesting opportunity for me today than it was 4 or 5 months ago. And that's why our weighting has gone from 4 or 5% there to 8.5%. As the price has run up, we haven't actually sold the stock because we're more comfortable with it than we were. This has really been the market for us for the past 2 or 3 years now. There's this macro pessimism about Australia has been creating plenty of opportunities for us to create money. The portfolio has been changing quite a bit as we find new opportunities. We've had 2 takeovers in the last 3 months. We've probably had 4 or 5 of those over the last couple of years. It's actually quite a good market for identifying undervalued opportunities and then getting that value realised, because the market's not buoyant, so the prices of everything is not up, but it's also not that pessimistic that people are not realising value when it is in front of their faces. So to the business, to what we've been up to at Forager, I think some of you were in the room here when we first went and passed the hat around back in 2009 and raised roughly $10 million for the Australian fund. It didn't move much from there over the next few years. The past 4 years for us have been very good. We separated from Intelligent Investor at the end of June last year, and we're really enjoying life on our own 2 feet. We're really confident that we can continue to attract customers to this business, and in fact, some of the stuff that Alex has been working really hard on over the past year is working very well for us, just in terms of attracting the right types of customers for this business. The left-hand side there's a summary of the business at the moment. We've got 78 million in the Australian Shares Fund, as you would know it. We run 24 million. We've had that fund basically since the day we started for a bunch of financial planners that they had a fund that was in a lot of trouble, and they basically handed it over to us to run. We've done a very good job for them, so that has remained a part of our stable. But we're up to $102 million there in Australian equities. We said when we first started that we thought this strategy had a capacity limit of $150 to $200 million. I'm not seeing anything that suggests that that's a whole lot different, to be honest with you. We already find situations where we like a stock, we think it's very attractively priced, we just can't get enough money into it. So we think we've got another 50 million or so of capacity there, and we're going to need to start thinking about closing it, and we're going to need to start thinking about how we manage that over time. So that's something we're talking about at a board level at the moment, making sure that we do it in a way that's fair to everyone. But it's another $50 million or so away from where we are today. And who knows, in 5 years' time, the Australian market might be a whole heap bigger and we might think we can make it work with 300 million, but I'm not seeing a lot of evidence that what we're doing at the moment is going to work at $500 million. And I still think it's very, very consistent across the market that you see people get great track records with $100 million of funds under management. All of a sudden the money flows in, they've got $500 million, and the markets go back to being, the returns go back to being market returns. It is such a small space in Australia that is got so many funds chasing it in that 500 million to 2 billion market cap. You know, the REAs and SEEKs and ARBs and good businesses out there, but you look at the prices that people are paying, and I don't see how that's going to deliver double-digit returns over time. So we will cap it at some point in the next few years. The international fund's $86 million. We've actually raised more in terms of fundraising for that fund than we have for the Australian fund, which just shows you the demand that's been out there for international assets. I'll talk about the performance of that fund in a moment, and total of 188. That's a good point for us. I know a lot of people were actually worried about how the business economics worked in the early days. We're generating enough revenue now to employ the people we want to employ and have the systems that we want to have, and have a business that is an exciting place to work, and we can hopefully grow over the next 20, 30 or 40 years. I just put some numbers up there about our clients on the right-hand side. We have a huge advantage over a lot of other fund management businesses in that we're not dependent on any one client. We have a very diversified base of clients, most of whom have an average of $100 and something thousand with us. Now that is important because we're not beholden to anyone who may get upset or may want to take their money out or may react to short-term performance. A lot of other fund managers will have a research house or a financial planning firm that represents a huge part of their fund, and it makes it quite difficult to run your fund when someone is constantly looking over your shoulder. This is the Australian fund summary of returns to date. We've been having really the last 4 years. The first 2 years were quite difficult. I think we were still zero after 2 years of launching this fund. We're now 6 years down the track, averaging 14.5 per annum, and that's come pretty consistently over the last 4 years in 20% returns per year. It's been lumpy. We said it was going to be lumpy when we first started it, and it's certainly delivered on that promise. But like I said earlier, this is a really nice market for us to keep finding cheap things and sell them and find more cheap things. Everyone wants the market to go up. That's the last thing that we want in terms of running this portfolio. Just putting that into chart form, if you put 10,000 in on day one, you'd have 22.5 invested with us at the moment versus 15 in the index. So that gap is starting to get nice and big. And as I said, those first 2 years, you could have actually put your money in 2 years later and done just as well. The international fund is underperforming its index. You can see that number there, 2.7% per annum. We've had a better last year and a better last 6 months as stocks like Betfair have made up for some of that underperformance that we had in the oil services space. I'm always harassing the guys. I always want more, and like I said earlier, I want more of those needles in the haystack opportunity in this portfolio than we have at the moment. But if you told me that the market was going to go up 23% a year when we launched the fund back in 2013, I would have said we would have underperformed by more than we have. We've carried a lot of cash. We've been pretty conservative in terms of the way we've gone about deploying it. Currency's been a huge tailwind there. That's roughly 10% of that 23% per annum has been Aussie dollar depreciation against the rest of the world. But it's still been very buoyant times for markets, and that's been making life difficult. So we're hoping for a bit more of what we've seen over the past 6 or 12 months there, which is, stocks like Serene trading down more than half and giving us an opportunity to add those types of things to the portfolio. There you can see the stellar run. Basically from the day we started, markets have gone up and the currency's come down. So in less than 3 years, you've got almost $17,000 from a $10,000 investment with us, and you would have had more than that if you put it in an index fund. It's been a very good time to be invested in international equities, and I think that is now being used to market international equities to a lot of people. The Aussie dollar has already fallen a long way and the markets have already gone up a long way. So I think I thought that 3 years ago it was really a tied out opportunity or almost risk management that we needed to get a lot of our money invested internationally. And I know a lot of people heeded that advice and have done very well out of it. I think the balance now is reasonably even. I've got half my money internationally and half my money in Australia, and I don't feel a strong desire to do anything dramatic in terms of changing that. And that was it for my presentation. We're going to do a Q&A. We are recording this today, so you need to have a microphone before you ask your question, please.